The laundromat industry has become a topic of intrigue in America, often hailed on social media and investment forums as a prime source of passive income. However, the reality of operating a laundromat is far more complex, often hidden beneath seemingly attractive metrics such as revenue and equipment condition. For first-time buyers, understanding the critical decisions surrounding leases, utilities, financing, and operations is essential to avoid turning a promising investment into a financial burden. One of the gravest errors lies in overlooking the lease terms. A case from 2021 highlights this, where a first-time investor purchased a laundromat in the Midwest for around $450,000, attracted by its historical revenue and good equipment. Unfortunately, the lease had only a few years remaining, with no guarantee for renewal options. After 3 years, the landlord raised the rent by over 40%, leaving the operator with no alternative but to accept the hike, ultimately resulting in the business being sold at a loss. The lesson here is clear. The lease is not just paperwork, it is the foundation of the business. Another common pitfall is overpaying based on unverifiable income. In Texas, another buyer purchased a laundromat claiming revenues of $35,000 per month, but utility bills indicated significantly lower machine usage. After acquisition, the real revenue averaged closer to $24,000, leading to immediate financial strain. This case underscores the importance of cross-verifying seller-reported figures against utility consumption as a more reliable measure of performance. Utility costs are often the unseen drivers of profitability in laundromats. A buyer in an urban area assumed that strong revenue indicated financial success, only to discover that inefficient machines consumed more than 35% of gross revenue in utilities. The store required extensive equipment replacement within 2 years, an unexpected expense costing upward of $250,000. Thus, understanding utility economics is crucial. Revenue alone does not tell the whole story. Location also plays a significant role, and the right demographics are key. An investor in a growing suburban area assumed rising population numbers would lead to higher demand, only to find that an increase in home ownership reduced customer traffic as more residents had in-home laundry facilities. Successful laundromats thrive in areas with high renter density and limited access to in-unit laundry. Moreover, all laundromats eventually require reinvestment. Equipment ages and technological advancements necessitate updates. A buyer with 15-year-old machines faced skyrocketing repair costs and declining customer satisfaction, forcing an unexpected retooling far sooner than anticipated. Deferred maintenance can quickly lead to substantial capital expenditures. Additionally, the idea of passive income is a myth in this industry. A buyer who attempted to manage a laundromat remotely with minimal oversight encountered rising maintenance issues and declining cleanliness, resulting in a nearly 20% revenue drop in the first year. Operational discipline is essential for driving performance. Passive ownership is a privilege earned through effective management. Successful laundromat owners think like investors. They focus on aspects beyond immediate operations, understanding the value of lease extensions, equipment upgrades, and overall efficiency. 5 years after a similar purchase, one owner could sell their business for nearly double the value of the other. The laundromat industry presents genuine opportunities for those who grasp its hidden risks. First-time buyers must look beyond superficial metrics, adopting a long-term perspective rooted in infrastructure investment and strategic financial management to pave the way for lasting success. In this industry, understanding potential pitfalls is pivotal to converting a deal into a sustainable business. And remember, We are here to help any way we can.